Benjamin Franklin once wrote, "There is nothing more certain than death and taxes." And with home values in many parts of the country nearly doubling over the last decade, you may be wondering, how does capital gains tax affect me? So that's what we're going to get into in this video. I'm going to talk about what exactly is capital gains. Does it actually apply to you? And what are some strategies to either reduce or completely avoid having to pay capital gains tax? Now, before we dig in, I am going to disclose I am not a CPA, I am not an accountant, nor do I play one on YouTube. But I am a real estate veteran of almost 30 years, and I've had countless number of clients that have had to deal with capital gains. So I wanted to give you an overview of the basics of what capital gains is, but you definitely want to talk to your accountant, your CPA for your particular situation. So first off, let's talk about what the heck is capital gains tax, because it is kind of scary when you hear the stories about people having to pay tens of thousands of dollars unexpectedly. So at the core of what capital gains is when you sell an asset, whether it be a stock or an investment property or your home, the money that you walk away with, the profit, is subject to a tax, and that's called capital gains tax. And yep, the government's got to get their hands in your pocket for their piece. However, it's not quite as simple as that, because there is something called cost basis. And what cost basis does, it takes into consideration the money that you've made, invested in your home for improvements, and what is allowable to be considered for that. Because what that will do is it will reduce the amount of capital gains that you'll have to come up with. So I'm going to give you an example of what this might look like in your particular situation. Now, say you've been in your home for 25 years, and 25 years ago, you purchased the home for $150,000. And over the last 25 years, you have made $50,000 worth of qualified improvements. And we're going to talk about what that means a little bit later in the video. So $50,000 of qualified improvements. Now your adjusted cost basis, which is what we're working on here with capital gains, is $200,000. Now, fast forward to today, you're looking to sell the property. It's no longer worth 150. Now you're going to sell it for 600,000. Selling the sale price is 600,000. You're going to take that cost basis and you're going to subtract that number from what the property is selling for. Now you've got a capital gains amount of 400,000. This is what your capital gains tax is based on. And there are some strategies. You can kind of see this where it might be coming together. We're going to get into that in a minute. But right now, that is basically how the capital gains tax is calculated. Now, there are two different types of capital gains categories: short-term and long-term. Short-term would be as if you only own the property less than a year. Long-term is over a year, and over a year you get into the lower tax rates. Now that's where you need to talk to your CPA or your accountant to figure out what your tax rate is on that 400,000, because everyone's tax rate is going to be slightly different. And that's why capital gains is not cut and dry. It's not a good or bad yes or no answer, because everyone's situation is going to be slightly different. Now you can see how this might sneak up on you, especially if you've been in the home for a long period of time and you have accumulated a lot of equity. But the good news is the IRS has some exclusions, and you may not have to end up paying any capital gains tax at all. Now, the first exclusion is the primary residence exclusion. You have to be there as a primary residence. It cannot be for a second home. It can't be for a vacation property, investment property, Airbnb. It has to be for your primary residence. And with this exclusion, you get $250,000 if you're single and $500,000 if you are married. So if we jump back to the example I was working on earlier, and you have a $400,000 capital gains liability, now we're going to take advantage of the exclusions. So if you are married and you have a $500,000 exclusion, that nullifies the entire amount. Now you will not be paying any capital gains on that property. However, if that's not the case, and say you are single and you're selling the property, it's $250,000, now you're on the hook for $150,000 taxable amount. So your capital gains tax will be based on the 150, not the profit, not your net proceeds, not the sale price, but the 150,000 at whatever your particular tax bracket is what you will be held liable for capital gains. Now, in order to take advantage of that exclusion, either the 250 or the $500,000, you do have to meet two qualifying criteria. One is that you have to have owned the home for at least 2 of the last 5 years, and you have to live in the home as your primary residence at least 2 of the last 5 years. They do not have to be consecutive years. You don't have to live in the home for 2 consecutive years in a row, but you do have to call it your primary residence for at least 2 years. One, and then you can rent it for a year and then call it another one. But it has to be 2 years, the last 5 years, it has to be your primary residence. Another note is that if you are married, both spouses have to meet that criteria in order to qualify for the 500,000. So if you have lived in your home as a primary residence and you have called it your primary residence for at least 2 years, but then you recently got married and your spouse has only lived in the house for a year, you will not qualify for the $500,000. So something to watch very, very closely. Again, you want to talk to your accountant, your CPA, to make sure that you meet all of this criteria before you make a decision on whether you should sell your home or not. Now, part of knowing what your capital gains tax is to know what your current market value is. And if you're trying to figure out whether you should even sell now, if now is the right time, if you can afford to, based on what your capital gains liability is, one of the key elements is having a realistic understanding of what your home is actually worth. And that is not what the Zillows and the Redfins and all the other, Realtor.com and whatnot, all the websites every website will give you a different number. So who do you believe? Well, you want to reach out to your local real estate agent, and you don't want to reach out to just any agent. You want to make sure that you talk to a 20% agent. Well, what is a 20% agent? Well, it's my belief, after dealing with real estate agents for a long time, the state of affairs is that about 80%, in my opinion, 80%, unfortunately, in the real estate industry are not they're not up to snuff. Let's just say that they're not entirely skilled, professional. They're not always looking out for your best interest. They're not going to necessarily give you a reliable number. So that is 80%. So what do? You want to look for a 20% agent and interview at least 3 agents. Now, I have contacts all over the country. I refer on a regular basis, coast to coast agents. I put clients in touch with 20% agents, folks that I have done business with or I've come in contact with that I've interviewed personally, that I can put my stamp of approval on, that they are an actual 20% agent. I would want you to reach out to one of those agents. Now, if you would like me to get you in touch with one of those, fill out the link in the description. I'll get in touch with you. We'll make sure you get connected. But that 20% agent will give you a number, and it's not going to be pressure. It's not going to be a hard sell. Try to get you to sell now. It'll be a conversation where you say, hey, listen, I'm trying to figure out whether I should sell it all based on what my capital gains is, and I need to know realistically what my house is worth. A 20% agent will be able to give you that information for you. And that way you can know before the set for sale sign goes in the ground whether the timing is right for you to do anything in regards to selling your home. So what are some circumstances where you might end up owing capital gains and things that you can kind of keep an eye out for? Well, one is if you haven't lived there for the last 2 years. I mentioned that earlier as a qualifying event, but what happens if you have a life change event, like a divorce or health issues or a death of a spouse or job relocation? There are circumstances where there can be exceptions. And again, you want to check with your CPA or your accountant to see if you qualify for one of those exceptions. But another area might be that you think you were in the home for 2 years because maybe you did rent it, you lived in it, then rented it again, lived back in, but the total number of years and number of months didn't add up. If you weren't there a full 24 months in the last two years of the last 5, you have to be 24 months of living there as your primary residence, then the IRS, in their eyes, you're on the hook. There is no exclusion. You can't take advantage of that $250,000 or $500,000 exclusion. Now, what happens if you get divorced and say you buy out your spouse, but then you decide that you're going to sell the property? You will not be able to take advantage of that $500,000. You will have to only be able to take advantage of that $250,000 if you decide to sell it after the split. However, in the case of a death, if the spouse passes away, the IRS does give you 2 years to sell the property and take advantage of that $500,000. Again, you definitely want to check, again, CPA, and you want to check with your accountant because it is the IRS and they change the rules all the time. So don't take my word for it, double check the information. But at the filming of this video, 2 years you will have to sell that property if your spouse passes away, and you can still take advantage of that $500,000 tax exemption. Now, inherited property, on the other hand, is treated a little differently. The IRS uses what's called a stepped up basis. So instead of referring back to the purchase price of, say, what your parents paid for the home back 25 years ago, now they're going to look at what the current value is. That is becomes the cost basis number from the starting point. So $600,000. So if you inherited that property today and the property value today is $600,000, you sell it tomorrow, the capital gains will be zero. However, if you can't agree, your siblings can't agree to sell the property, don't know what they're going to do, we're just going to hold on to it for a while, and you hold on to it for a year, 2 years, now you will be subject to capital gains because you've held that property. The window to sell the property on that stepped up basis is very small. So you want to keep that in mind, that you're not going to get stuck paying huge capital gains on an inherited property. But if you hold it, you ultimately will potentially get stuck with having a big tax bill. So let's talk about some strategies to help you either reduce or get rid of those capital gains taxes altogether. And one of the best ways to do that is to leverage the home improvements. If you can add more home improvements, qualifying home improvements, to increase that cost basis number, that will significantly reduce the amount of money, the basis number that the capital gains are based on. So the home improvements that are allowed per the IRS have to be improvements that actually add value to your home. So the reason why that's important is things like maintenance items, painting, and any type of cleaning or regular home maintenance does not add value. It has to be substantial value added to the property. Ideally, things like maybe a septic system. Is one of the ones that I always think about. Is a septic system, at least up here in the Northeast, is not inexpensive. It could be anywhere between $20,000-$30,000 or more. And that, because it's reasonable to expect when you buy a home to have an operational septic system, it doesn't add a ton of value. So it doesn't increase your sale price, but it significantly reduces and increases your cost basis number. But some of the other items that the IRS has, and there is a complete list on the IRS.gov website, but they refer to structural and systems upgrades like roof replacement, HVAC systems, plumbing and electrical system upgrades, a new water heater, water filtration system. You could also look at, if you have any additions, modifications, expansions, room additions, adding a deck, adding a garage, finishing a basement, or if you have a third floor walk-up attic, finishing that attic. Interior renovations, such as kitchen, bathroom remodels. If you put built-in cabinetry, add storage, flooring upgrades, hardwood tile, replacing windows indoors even, exterior improvements, siding, driveway, walkway installations, fencing, retaining walls, landscaping, and an energy efficient upgrades like solar panels, solar water heaters, and energy efficient windows or insulation. Again, this is not a complete list. Hopefully this will get the wheels turning for you. And by all means, you want to make sure that you double check with your CPA. This is a repeating message. Check with your CPA, check with your accountant to make sure that the upgrade that you're looking at before you spend the money, if it's something that is optional, if you're doing it to help you save that taxes, that tax liability amount, make sure that that is actually on the qualifying list, that you can add it to that cost basis number. Now, there are a lot of loopholes. There's a lot of different exceptions and different qualifying criteria that you may qualify that only your CPA and your accountant is going to be able to advise you on. And that is why, as a repeating message throughout this video, that you really do need to talk to a professional to find out if you qualify, if you have a particular situation, you have a special situation that's not cut and dry, that might actually work in your favor so that you don't end up having to pay tens of thousands of dollars when you go to sell your home. Now, if you want more information about how you can properly prepare yourself to sell your home, you're going to want to check out these videos. I'm Jen Sylvester. I'm here to help you be a savvy home seller.